If you follow the silver market regularly, you've probably noticed something unusual developing between the Shanghai Futures Exchange and COMEX in New York. Both markets are supposed to represent the same metal, the same global commodity, and the same underlying value. Yet lately, they seem to be sending very different messages. Before we dive into the details, I want to make something clear. I'm not going to focus on a specific silver price because by the time you're watching this, the market may have already moved. Instead, let's focus on what matters far more than a temporary quote: the relationship between these two major exchanges and what that relationship may be telling us about the silver market as a whole. For well over a year, silver in Shanghai has frequently traded at a noticeable premium compared to COMEX. This isn't a small difference that appears for a day or two and disappears. It has shown up repeatedly and often enough that it deserves attention. When one of the world's largest physical silver markets consistently values silver higher than the primary Western benchmark, investors should be asking why. The Shanghai Futures Exchange is not a small regional marketplace. It is one of the largest commodity exchanges in the world and handles enormous volumes across metals, energy products, and agricultural commodities. Its influence has grown substantially over the past decade, making it a major player in global price discovery. When people talk about the Shanghai silver premium, they mean that after converting prices into US dollars and accounting for contract differences, silver often trades higher in Shanghai than it does on COMEX. At times, the gap has been several percentage points, and occasionally even larger. While premiums naturally fluctuate, the broader trend has remained surprisingly persistent. That persistence is what makes this important. A premium lasting a single day means very little. A short-term spike could simply be market noise. But when one market consistently assigns a higher value to a commodity than another market over an extended period, it usually reflects something deeper happening beneath the surface. In a perfectly balanced market, such differences shouldn't last very long. Traders would simply buy silver in the cheaper market and sell it in the more expensive one, capturing the spread until prices moved back into alignment. That's how efficient markets are supposed to function. Yet the gap continues to reappear. It narrows, widens, and sometimes fluctuates, but it refuses to disappear completely. That suggests there may be factors limiting the normal arbitrage process, and many analysts believe those factors are tied directly to physical silver availability. COMEX operates primarily as a financial marketplace. While physical delivery is possible, most participants never intend to receive actual silver. Hedge funds, banks, institutional traders, and speculators are generally trading exposure to price movements rather than accumulating physical metal. Most contracts are rolled forward or settled financially before delivery ever becomes necessary. As a result, the amount of paper silver traded on COMEX is often many times larger than the amount of metal actually available for delivery. This doesn't automatically mean there is anything wrong with the system. It simply reflects the reality that COMEX functions mainly as a price and risk management platform. Because of that structure, silver pricing on COMEX is heavily influenced by investor sentiment, interest rates, Federal Reserve policy, inflation expectations, currency movements, and large institutional positioning. Physical supply and demand still matter, but they are filtered through a financial framework. Shanghai operates differently. Its structure is more closely tied to actual metal movement and physical settlement. A larger portion of contracts ultimately results in metal changing hands, making the exchange more sensitive to real-world supply and demand conditions. When Chinese manufacturers, investors, or industrial users need silver, that demand tends to show up more directly in Shanghai pricing. In many ways, the exchange acts not only as a trading venue, but also as a mechanism for moving physical metal through the economy. This difference in design may help explain why Shanghai often appears to be telling a different story than COMEX. One market is heavily influenced by financial flows and paper contracts, while the other has a stronger connection to physical demand. And once you begin looking at silver through that lens, the premium becomes much more interesting. It stops looking like a temporary anomaly and starts looking like a signal that the physical market may be tighter than many investors realize. One reason this difference deserves attention is what has been happening inside the physical silver market itself. Over the last several years, the amount of silver registered and available for delivery on COMEX has generally trended lower. While there have been temporary rebounds along the way, the longer-term direction has been difficult to ignore. It's important to understand the distinction between registered and eligible silver. Eligible silver may be stored inside approved vaults, but it belongs to private owners and is not automatically available for futures contract settlement. Registered silver, on the other hand, is the metal specifically designated for delivery. That distinction matters because many investors hear that hundreds of millions of ounces sit inside vaults and assume all of it is available to the market. In reality, only a portion of that inventory is immediately accessible for contract delivery. As delivery requests gradually increase and registered inventories decline, the available cushion becomes smaller. At the same time, more market participants have shown a willingness to stand for delivery rather than simply roll contracts forward. The increase has not been dramatic overnight, but the trend has been noticeable enough to attract attention from seasoned silver watchers. Shanghai presents a different picture. Physical settlement is a much more common outcome there. Buyers often expect to receive actual metal, and sellers are expected to provide it. Because of this structure, price movements tend to reflect real-world supply conditions more directly. This becomes even more significant when we consider China's role in the global silver market. China is the world's manufacturing powerhouse and one of the largest consumers of silver on the planet. The country uses enormous amounts of silver across industries, ranging from solar energy and electronics to telecommunications, electric vehicles, medical equipment, and advanced manufacturing. Solar demand alone has become a major driver. Silver remains a critical component in photovoltaic cells, and China leads global solar panel production by a substantial margin. Every new installation requires silver, and despite ongoing efforts to reduce silver usage per panel, overall demand continues growing because the number of installations keeps expanding. Beyond solar, silver is embedded in modern technology. It appears in electronic circuits, EV systems, charging infrastructure, 5G networks, industrial equipment, data centers, and countless applications that support the digital economy. As these sectors expand, so does their need for physical silver. What makes this even more interesting is that China's domestic silver production has struggled to fully satisfy its growing consumption needs. Although China is a significant silver producer, demand has frequently outpaced local supply. The difference has been filled through imports from major producing nations around the world. That steady flow of imported silver highlights an important reality. China is not simply trading silver contracts, it is actively pulling physical metal into the country. Refined silver is moving from global inventories into manufacturing pipelines and investment channels. This is one reason many analysts view the Shanghai premium as more than just a pricing anomaly. It may reflect genuine competition for available metal. When buyers need physical silver for industrial production, they are often willing to pay more to secure supply. Meanwhile, broader demand trends continue moving in the same direction. Global investments in renewable energy remain strong. Electric vehicle production keeps expanding. Data center construction linked to artificial intelligence and cloud computing continues accelerating. Electrical infrastructure upgrades are taking place across many regions of the world. All of these developments require silver. Not paper contracts, not financial exposure, actual physical silver that can be processed, manufactured, and consumed. Against this backdrop, the global silver market has experienced multiple years of supply deficits. In simple terms, the world has been using more silver than it has been producing through mining and recycling. The difference has largely been covered by drawing down existing inventories. That process can continue for a while, but inventories are not unlimited. Over time, shrinking stockpiles place greater pressure on available supply. As that pressure builds, markets that are closely connected to physical delivery often begin reflecting those conditions sooner than heavily financialized markets, and that may be exactly what Shanghai has been signaling all along. There is another layer to this story that often receives less attention than it deserves, and that is the role of global silver inventories outside both Shanghai and COMEX. London remains one of the most important hubs for precious metals trading, and over recent years, silver holdings across major vaulting systems have gradually declined. Metal has been moving to where demand is strongest, particularly across Asia, where industrial consumption and investment demand remain robust. This does not mean the world is running out of silver tomorrow. Mines continue producing metal, refineries continue operating, and markets continue functioning. However, what appears to be changing is the margin of comfort between available supply and growing demand. When that buffer becomes thinner, premiums often begin appearing throughout the supply chain. Many physical dealers have reported periods of elevated premiums on coins and bars compared to exchange prices. Industrial buyers have become increasingly focused on securing supply, and large consumers continue competing for available metal. These are not necessarily signs of an immediate shortage, but they do point toward a market that is tighter than many headline prices might suggest. Looking forward, there are several possible outcomes. One possibility is that silver prices in Western markets eventually move higher to better reflect physical demand conditions. Commodity markets have experienced similar situations before, where physical realities ultimately forced paper markets to adjust. Another possibility is that higher prices encourage additional supply. While that sounds straightforward, silver faces a unique challenge because most of it is produced as a byproduct of mining for copper, zinc, lead, and gold. That means increasing silver production is not as simple as opening a few new silver mines. Expanding supply often depends on economic conditions in entirely different industries, making the response slower than many people expect. A third possibility is that higher prices eventually reduce demand. Yet this argument has limitations because silver possesses properties that are difficult to replace. Its conductivity, durability, reflectivity, and industrial versatility make it essential across numerous technologies. While manufacturers continuously seek efficiencies, large-scale substitution has proven difficult. This is why many market observers continue paying close attention to the Shanghai premium. It reflects real buyers purchasing real metal for real-world use. Whether those buyers are manufacturers, industrial consumers, investors, or institutions, their willingness to pay above Western benchmark prices provides valuable information about market conditions. At the same time, broader global trends appear supportive for precious metals. Central banks around the world have been increasing their gold reserves, signaling growing interest in tangible assets. While central banks generally focus on gold rather than silver, the shift toward hard assets highlights changing attitudes toward monetary stability and long-term wealth preservation. Silver has historically followed major moves in gold, often outperforming during strong precious metals bull markets. Institutional investors have also shown renewed interest in commodities and real assets after years of dominance by financial assets. Retail demand for physical silver remains resilient as well, with many investors continuing to accumulate coins and bars despite market volatility. All of these factors form part of a much larger picture. For decades, commodity pricing has largely been influenced by Western financial centers, but China has steadily expanded its own pricing infrastructure and market influence. As the world's largest consumer of many raw materials, it wants pricing mechanisms that reflect physical demand rather than purely financial activity. Silver sits directly in the middle of this shift. The growing influence of Shanghai suggests that physical demand may gradually play a larger role in determining global prices over time. COMEX remains the dominant benchmark today, and that reality is unlikely to change overnight. But the direction of travel is becoming increasingly difficult to ignore. For investors who have long questioned the disconnect between strong silver fundamentals and sometimes disappointing price performance, this east-west divergence may represent an important development. It does not guarantee higher prices tomorrow, next month, or even next year. Markets rarely move in straight lines. What it does suggest is that the physical silver market may be sending signals that deserve attention. Shanghai continues to trade at a premium. Industrial demand remains strong. Global supply deficits persist. Inventories have generally been trending lower, while long-term demand drivers continue expanding. None of these factors alone determine where silver goes next, but together they create a picture of a market facing increasing pressure beneath the surface. The key takeaway is simple. When a physically driven market consistently values a commodity higher than a financially driven market, it is usually worth paying attention. Physical markets tend to reflect reality more directly because buyers ultimately need the metal itself, not just exposure to its price. Whether this situation resolves through higher prices, increased production, reduced demand, or some combination of all three remains to be seen. That is the story we will continue following together here on Agjon Silver Update. As always, this is not financial advice, it is analysis based on publicly available information and observable market trends. Do your own research, evaluate your own circumstances, and make decisions accordingly. Thank you for watching Agjon Silver Update. Stay informed, stay patient, and most importantly, keep watching the data because the market often tells its story long before the headlines do.